The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Stocks getting sold, bonds getting bought as the outlook for the economy deteriorates. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. Pretty ugly day developed in the markets.
Yeah.
We're kicking you off to the close. Let's get a look at it here. The S&P is off by 0.3%. We are off the lows of the session, but it's still been a very rough few hours for the market. Tech is underperforming, led down by the Mag 7 in particular. Tesla, the tech index, is off by over 1%. The bid in the bond market continues, now down 10 basis points on that 10-year yield, Romaine.
Yeah, make no doubt about it. Really, what you're seeing right now are investors who are girding for weaker economic conditions. This as government policies continue to weigh down optimism for both businesses and consumers alike. The consumer confidence data that we got this morning, not inspiring much confidence at all. The Mag 7 plunging into correction territory today. The KBW Bank Index doing the same. Bitcoin flirting with the bear market, and the S&P now poised to close below that 100-day moving average for the first time since last summer. The U.S. exceptionalism narrative that we've been hanging on clearly at risk right now. As well, we look forward to the next big economic releases that are going to be much more important than we thought. Orders for durable goods are coming out on Thursday. Personal income and spending is out on Friday. And don't forget, we get another crucial earnings report from NVIDIA on Wednesday. It's going to be the first update from that company since DeepSeek upended the artificial intelligence trade. But the bond market really not content to bide its time. We're witnessing right now the biggest one-day drop in yields since January 15th. And that's an important date because that was when benign inflation data revived the case for interest rate cuts by the Fed. Those bets did ebb in recent weeks, but have since been renewed today. Swaps pricing in almost 60 basis points of easing by year end. But Bank of America CEO Brian Moynihan isn't quite on board.
Inflation is coming down, but is a bigger fight. And in the end of the day, there's the dual mandate, employment, inflation. Employment, they're in great shape on. Inflation, it's been coming down, it's working its way down. It takes multiple years to squeeze inflation out. Our expectation is they won't cut rates. I think we have
for the whole rest of the year.
Yeah, for the rest of the year and the next year, and frankly.
No expectation for rate cuts, Alex, but as we've seen in this market, expectations can change pretty fast, and they've changed a lot over the last few weeks.
Yeah, I feel like we're going to a growth scare from an inflation scare just from last Friday. This is a chart that really exemplifies the market action that Romaine was talking about. This is that U.S. Consumer Conference data that we got out at 10 a.m. Now, equities were already weaker, bonds were already bid before the data, but this was kind of the icing on the cake. This 80 line here is the recession indicator. You fall below it, that's usually what triggers a recession, and we're right now at 72.9. Now, what was interesting is I was talking to the head of the data on Bloomberg Radio is that it was broad-based, that decline, Romaine. It was with Democrats and independents more severely, but there was also a decline in confidence when it came to Republicans with worries about pricing really front and center.
Yeah, and I think the broad-based nature of that decline is a big part of the reason why you're seeing the markets rattled. Let's get some insights out of someone who knows this much better than us. Tony Rodriguez kicks us off to the close, head of fixed income strategy over at Nuveen. Nuveen with more than $1 trillion in assets under management. And Tony, I'm sure you've been taking a look at the economic data, and we always have to have that asterisk that, one data print does not necessarily mean a trend. But we have seen a shift. We don't necessarily call it deterioration, but certainly a shift in expectations around inflation and about conditions in the economy.
Absolutely, Romaine. And, one example that would be like the Walmart outlook, obviously the largest retailer out there. So you are definitely seeing some signs of a slowdown that we've been anticipating. And when I say that, the economy had been growing close to 3% now for quite a while. Mm-hmm. We think we're going to see a deceleration into kind of the 2.5% range in the first half of the year, more to a 2.5% range in the second half of the year. So a lot of this is consistent with that slowdown, but the market is now coming to grips with not only that fundamental story around the consumer, maybe business investment moderating a bit, but also some of the uncertainty that we're seeing in other parts of the kind of global picture, thinking tariffs, immigration, geopolitics. So that mix is starting, I think, get priced into the market now.
I'm curious, specifically when it comes to treasuries, is what's being priced in right now more about safety and haven bids, or is it much more tied to just the idea that the Fed will somehow be forced to cut rates sometime soon?
Yeah, I think right now at the long end, it's really about safety, economic weakness possibilities. So the kind of tail risk, we're not calling for recession. We just think we'll see a kind of soft landing slowdown. But that tail risk of recession has increased. So I think you're seeing that priced in right now on the long end of the curve.
How low do we go in the long end in the short term?
Our view had been that kind of fair value is really 4.5% for most of the year, and we trade in a 4.25 to 3/4 range. So we're kind of at the low end of that now. We were there a year ago, if you recall. So we think that the inflation story, while we expect it to moderate, is going to continue to be sticky. That's going to cause the Fed to kind of be more patient than otherwise when they're looking at the economic data. So I think that helps to keep rates, long end rates, in this current range. Might we break through for a short period? Absolutely. But we think once you get below 4.25, there's much less relative value available in rates.
When we have an inflation scare over the last few years, credit markets did just fine. Now that we're sort of teetering on growth fears and growth worries, are the credit markets holding up as well?
They are. Now, our view there is that we're likely to see a little bit of weakness out of the credit markets, and that's because we're priced for so much good news. We think the fundamentals will remain solid. So you think about corporate earnings, think about cash flow, think about defaults. We're relatively positive on all those metrics, but a lot of good news is priced in. Spreads are at relatively tight levels. So we do think we'll see we've already seen a little bit of modest widening in the last couple of weeks.
Yeah.
We think that we might sit there a touch wider, but the overall story on credit is still pretty fundamentally sound.
But how quickly can that change? I mean, we've seen a few bankruptcies from some big retailers. And obviously, we should point out these are retailers that were having issues long before whatever situation we're in right now. But you have restaurants coming out and warning that their costs are going up, and that could be unsustainable. You had the CEO of Alcoa at a conference today talking about 100,000 jobs could be lost. And obviously, some of these are pie in the sky estimates here, but you clearly have a business community that's a lot more worried, at least publicly, than what they were, I don't know, even 3 months ago.
No, absolutely. We think for it to really materially change, you need some sort of exogenous shock. So right now, a lot of people are pricing in some various scenarios for, be it tariffs, be it immigration, be it regulation, be it tax policy. As long as we stay within some fairly wide guardrails, then I think we're going to be able to push through this with some modest volatility, but not a big break in the markets. But if you get a big surprise out of any of those areas or some kind of unknown, that's when you'll see a break in the credit markets and the equity markets.
So where are you putting cash at, or where are you finding opportunity in this market right now?
Sure. So right now, I mean, some of the areas we think, because we think the Fed, while we do think they'll cut this year, it's only going to be 1, maybe 2 cuts. We think floating rate assets are pretty attractive. So leveraged loans, CLOs are attractive. If you want to take on some duration risk because there is that downside possibility, then we think taking long duration risk in high quality assets, think of the municipal market, investment grade credit, those areas are attractive. And we think financials are pretty well positioned still. So the preferred market is actually still an area that has some value.
Romaine at the top of the show was talking about U.S. exceptionalism, and we've seen that shift just a touch into, say, European equities, for example, out of U.S. equities. This is the theme. Do we see the same thing, though, when it comes to, say, the bond market?
Yeah, so I think in the bond market, from a credit markets perspective, I think the U.S. exceptionalism is still in play, that the fundamentals are much stronger here. Where I do think you'll see some positives out of non-U.S. is from a rate side of the equation. So think of sovereign rates, sovereign yields like Europe, for example. We're a little more pessimistic about the economic outcome, more room for rates to drop there. And then in emerging markets, there are some parts of the globe where you have very well-positioned corporates that are attractive opportunities, but it's not a blanket emerging markets overweight. It's more of a bottom-up country and corporate by corporate analysis there.
Well, just looking ahead for this week, we get a lot of home sale data. We get inflation data coming out at the end of the week. Like, what are you keying in the most on?
So we're keen on 2 things. One is this week PCE. So there's an expectation we come in at 2.6. Our view is that we probably end the year closer to like a 2.5 or 2.4. So progress on that front. And then, of course, next week, the employment report, because the Fed is clearly very focused on both of those. And any weakness that we see in employment, that would be something that could drive us to lower levels on the 10-years we talked about before.
All right, Tony, great conversation. Tony Rodriguez, head of fixed income strategy at Nuveen, kicking us off to the close here on a decidedly risk-off day, and that could really be seen in the moves in Bitcoin. Battered down, trading at the lowest level since mid-November. We're going to discuss if the Trump-fueled crypto craze has officially lost steam. That is breaking news, Alex.
It is, right? All right. Also, Tesla is selling off sharply on plunging sales over in Europe. A conversation on the broader space and the appetite for EVs with the Vice President of Strategic Partnerships at the Swiss automation giant, ABB.
I don't know if you've tried to buy eggs as of late, Alex. You can't even get your hands on them. We're going to discuss a little bit later here whether prices could come tumbling down. We're going to talk to Tom Flocco. He's the CEO of Pete & Gerry's, the owner of the largest organic and free-range egg brand in the country. All that and more coming up in just a bit. This is The Close on Bloomberg.
I'm excited about David Sachs coming in, and actually, if you saw our investor day, crypto and AI are the two technology trends that we believe will shape Robinhood's future and the future of the financial industry. So actually seeing that the government is aligning itself with these trends and making sure that the U.S. is number one, I think it'll help us.
That was Robinhood Markets CEO Vlad Tenev there speaking on Bloomberg earlier with Sonali Basak and Tim Stanovic talking about the future of crypto under the Trump administration. Right now, crypto really struggling. Bitcoin, for example, sliding below 90,000. That rally that followed Trump's win is now being put into strong reverse here. Mike McGlone is senior commodity strategist at Bloomberg Intelligence, and he joins us now. Mike, what's my downside?
70,000 is probably a good support level. The key thing about Bitcoin now, it looks like it's putting in a pretty good island top. I mean, it has to get above 90 or else that island top, it's famous for that. And the other key thing is you look at other cryptos like Ether. Ether looks like it's heading to 2,000. And I think the key thing that people missed about this space is before President Trump was elected on CoinMarketCap.com, there was about 2,000 cryptos listed. Now there's 12 million cryptocurrencies listed. Unlimited supply is not good for prices.
12 million?
Wow.
Yeah. Okay. All right. I don't even know how to digest that. But Mike, when it comes to this idea, though, as to whether there is a trade here, and it seemed like a big part of the crypto euphoria that we saw over the last few months was on this idea that you have an administration that's way more friendly to crypto, or at least they promise to be, than the past administration. I mean, why is that being sort of lost in this sell-off?
I think it was the extreme, and the key thing you mentioned was a trade. It's a trade. Cryptos are a massive, giant casino on a global basis, and let's not underestimate. It's a great place to trade, buy and sell, but to actually invest in some of these things, you look at the Bloomberg Galaxy Crypto Index. It did not take out that high from 2021, and it's going lower. So a key thing to remember is, yes, now this allows companies to do things with the technology, which is awesome. The most widely traded crypto is Tether. That's the US dollar token. But they're also creating a lot more cryptocurrencies, so it means the actual price of those cryptocurrencies to go down. And I look at it like companies creating and producing commodities. It's great for those companies to create profits, but the actual price of the commodity going down. So Bitcoin is supposed to be digital gold. I think it just got too expensive. And the whole space to me looks very similar to what we saw in the peak of the dot-com bubble in 2000, almost exactly 25 years ago. So I'll end with this. One key thing is you look at cryptocurrencies like Dogecoin. It's still worth $30 billion. You can lop a zero off that price and it's still overpriced.
Yeah, but then you have gold clocking down by about 1.4%. I told you I'd give you a good yeah, but Mike. I mean, this feels like a baby bathwater thing, not a Bitcoin specific thing.
Yeah, so one thing about gold always goes down initially when the stock market goes down, and there's a lot of leveraged hedge funds and long managed money net positions are really long gold for a reason, but it's bumping down now 2,900. It's good support. The difference is I love watching that Bitcoin to gold ratio. Right now it's about 30 ounces of gold per one Bitcoin. The peak was 40 and looks like it's heading back towards 20. And the key thing to remember, there's an unlimited supply of precious metals. There's only 4: gold, silver, platinum, and palladium. And then I mentioned there's 12 million cryptocurrencies. I call them competitors to Bitcoin, and that's the key difference with the space. So I still think gold's going to be the better performer. And I'll end with this. On a 1, 2, 3, and 4-year basis, gold is outperforming the S&P 500 total return. That's not a good sign for the global economy.
So when we start to look at, I mean, obviously we're getting the downtrend here, but when we looked at that run up that we saw in gold, was that sort of people betting on this idea as either a hedge, a safety play, or kind of contra to what the Fed would or won't do?
So I think the key thing when we think about gold, Romaine, is the key thing that's been driving gold is geopolitics, the Russian and China's unlimited friendship. But central banks have been the best buyers. ETFs have had 4 years of outflows. Prediction, I think this will be an inflow. They're just an inflow year. They're just starting to kick in. So investors haven't had any reason to be in gold because the stock market's been on tear and bond yields are higher. That's potentially reverting. Bitcoin going down is a good indicator for that. So I think gold is going to continue to be the best performer, potentially versus Bitcoin. And ETF investors are just starting to jump back in.
All right, Mike McGlone, senior commodity strategist over at Bloomberg Intelligence. Gold down more than 1% here on the day in the spot market on an intraday basis. Worst decline going back to December. Bitcoin down for 3 straight days here as we keep an eye on the broader markets. And we keep an eye on some of those earnings that we've already gotten, including from Home Depot. Some of the slower growth and the higher interest rates and that shift in consumer spending wasn't enough to shake investors' confidence in shares of Home Depot. Those shares higher. We're going to recap the retailer's latest print. That's coming up next in our top calls. This is Bloomberg. All right, let's get a view from the sell side. Top calls, the big movers on the back of analyst recommendations. And we start off today with Warby Parker. Roth MKM starting coverage of the eyewear company with the neutral rating and a $26 price target. The analyst considers the company to be a formidable player in the industry, but he still wants to see more improvements on the brick and mortar front before he considers a buy rating. Shares down about 3% on the day, down for a 4th straight day. Next up, the health tech company Tempus AI. A downgrade to neutral at JP Morgan after the company's 4th quarter revenue missed expectations. While the analyst says she believes in the company's core business, combining diagnostics and data, she doesn't believe the valuation justifies an overweight rating. Those shares down 16% on the day, one of the biggest drops since going public last year. And finally, let's take a look at Walmart. Getting an upgrade today to buy from hold over at DZ Bank, despite a somewhat uncertain outlook from the retail giant. The analyst says last week's share drop was exaggerated and says Walmart's past quarterly performance should exceed any negative reaction. The analysts there setting a price target of 110, above where we are today and above the 4% gain that we have on the day. And those are some of our top calls. We want to stay in the retail space right now and turn to Home Depot. Those shares higher as well after the home improvement company beat estimates for same-store sales and profit last quarter. However, management did flag that higher interest rates and macro conditions could impact growth going forward. Let's bring Seth Basham into the conversation, equity research analyst covering retail hardlines at Wedbush. He's got an outperform rating on the shares. All right, so I don't know where we sort of start. Do we start with the quarter that just once was, or do we sort of look ahead to some of the commentary that they gave, Seth, that didn't seem to rattle investors? They seem to be, I guess, somewhat okay with the guidance.
Yeah, the quarter itself was pretty good. It beat consensus expectations, slightly below our bullish views, but still a good quarter nonetheless. And it showed broad-based improvement and engagement in home improvement by the consumer. So that's a good news story right there. Looking forward, however, the company threw a little bit of cold water on the outlook by guiding 2025 modestly below consensus forecasts, especially on the top line, and in addition to the margins. But nonetheless, their forecasts seem conservative. We've seen that broad-based improvement, and we expect the consumer to engage with the category more going forward as they consider whether or not to move or whether to re-engage in home improvement and renovate their places. It's getting long in the tooth. People making those decisions that have been on hold for a long time, they're going to be forced to renovate if they're not moving.
I am curious, just in your own view, over there at Wedbush, Seth, I mean, how confident are you in economic conditions to be supportive of Home Depot and its business model?
Yeah, there's certainly a fair amount of uncertainty with the macro outlook, geopolitical outlook. Consumers are holding on to their wallets right now, but there's certain things that they have to do in order to maintain their homes. So half the business for Home Depot, that's maintenance and repair, that's going to get done. And then it's those things around the edges that are getting done a little bit more, painting and refreshes, some yard work. But it's those incremental discretionary projects around kitchen and bath remodels that are more expensive and that really require borrowing that are soft right now. And more on the margin, we think we'll see those get done over 25 and 26. But we don't need many of those to get done to drive upside to forecasts.
Yeah, I mean, they did mention refinancing activity, so there clearly is happening in the space. Lowe's is also up on the news, Seth. So I'm wondering if the interpretation is not that HD is stealing Lowe's business or its lunch, but that the whole area is conservative right now.
Yeah, it's more the latter. The area is conservative. The home improvement retail sector seems to have bottomed out. And from here, it's just a matter of how shallow the recovery is. Will we see improvement in 2025, or do we have to wait to 2026? From our perspective, we have a slightly more bullish view than Home Depot's forecast for the industry to be flat to slightly up in 2025.
What rate from the Fed or on the 10-year does that then imply for you guys?
Now, honestly, the 10-year can stay where it is. So we see some things that are driving demand, some of which I just mentioned. In addition, we could see a little bit of benefit of the top line from tariffs, Chinese tariffs, with 30% of Home Depot's goods coming from China. That's a positive. Lumber prices could be a positive. And then they have the contribution of one of their acquisitions in the comparable store sales base, which could drive some 20 basis points of upside. So there are a few things on the margin that can drive a little bit of upside here without a change in the housing environment.
I am curious, though, too, because when we talk about the housing environment, I mean, we'd be remiss in not bringing up the issues with regard to immigration and the labor market and helping to facilitate that growth. And if there is an interruption in that, how does that trickle down to Home Depot?
Yeah, no doubt. If there is mass deportations, it's going to be a problem, especially for home building and for the remodeling industry. The portion of the industry that's done by pros, which is a big portion, almost half of Home Depot's business, will come under some pressure as well. Certain trade classes have immigrants representing 30+% of the labor force, especially flooring as an example, and we could see some pressure from that. So we'll be watching how that policy plays out and the implications for Home Depot. I'd say that's one of the major risks, along with demand destruction from higher tariffs.
Yep, exactly, those higher tariff potential. All right, Seth Basham, thanks very much over at Wedbush. We appreciate your time today. And speaking of tariffs, Romaine, the National Restaurant Association is trying to get food and drinks exempt from tariffs, estimating that those kind of tariffs could cost the industry over $12 billion.
Yeah, I mean, I thought it was interesting, too, when we talk about sort of the percentage of these businesses that are tied to food costs. They're pegging it at somewhere around 33% or something. So basically a third of their costs. So even an incremental move can have a huge impact on margins. Margins that we know for some of these companies are pretty tight already. But here's the question. How do you exempt just food and beverages without, because a whole big part of this tariff push is focused on commodities and other things. So do you just pick and choose? I'm going to do wheat, but not rye? Or
everyone wants to get in on this now, too. Like there's been reports out, I think it was Goldman Sachs that said that if you have the 10% tariffs on oil that are imported from Canada and Mexico, you could be facing 7 cents a gallon. Steel issues tariffs when it comes to the oil industry could be $3 billion worth.
And the other question, though, too, is if you exempt one thing, there is sort of an interconnectedness to all of these items, too. So maybe you save a little bit on that, but you still get dinged on something else that could affect your labor costs or your energy costs or something like that as well.
If you don't make it here, that's the whole problem. It's going to trickle down. All right, well, coming up, a shift towards electrification over at, I'm told, NASCAR.
Yes.
They race cars. Vice President of Strategic Partnership at ABB will join us about the latest endeavor there. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Alex Steele. We talk about the Mag 7 being in correction, but one of the big standouts recently has been Tesla. Now that market cap under $1 trillion.
Yeah, I was taking a look at that. Because they just kind of crossed that $1 trillion mark. What was it, last fall or something? So to kind of see it drop back below that, and it's been pretty dramatic. They're now testing that 200-day moving average, and a lot of this, of course, seems to have to do with their CEO, basically, the guy who's been distracted by other things, let's just say. But even before that, there were a lot of concerns about whether there was a slowdown in adoption of EVs overall or whether it was just something very specific to Tesla.
Right. And then the news out today that Tesla sales in Europe fell. Now, part of that's also inventory. If you don't have the inventory there, then it's going to be hard to sell the cars. But nonetheless, losing some market share to some of its peers. And then the rollback from the Trump administration on certain EV initiatives.
I've been actually surprised by that. Of course, removing chargers from federal facilities, but even sort of this idea of just nipping away at the subsidies and other things that kind of help Tesla and, for that matter, other EV makers grow, which seems odd given that Elon Musk basically has a seat at the table in theory.
Unless he's pivoting to sort of just the autonomous vehicles, autonomous vehicles and and battery storage. If that's now really the bet for Tesla.
I mean, here's the thing though too, and I think just to kind of get to this idea that this stuff isn't going away, right? I mean, we may see a slowdown, may see a speed bump here, but when we talk about electrification of vehicles and all the things that go along with that, that's still kind of full steam ahead. And I actually had a chance to go down to the Daytona 500, which is in Florida. Alex,
oh, thank you.
I did not see you. It's a big race, NASCAR. Vroom,
totally
vroom.
there.
Anyway, it was a great event, and I had a chance to kind of see maybe what potentially that future would look like. It was actually for the first time in the 67 years that they've been running the Daytona 500, all of those gasoline-powered vehicles, they were actually led out onto the track by an all-electric pace car. And then on top of that, just outside the speedway, there was an all-electric race car that was doing donuts in the parking lot. And it was really the first official foray that NASCAR's biggest event has really given to fans to kind of taste what an EV future could look like for the U.S. motorsport powerhouse and playing a big part in that initiative. And that car you're seeing on the screen is a Swiss automation giant ABB, which helped develop the prototype EV race car that was showed off at Daytona. Pleased to say that Chris Shigas, Vice President of Strategic Partnerships at ABB, joins us now here in Studio 2. And Chris, we should point out that car was a joint effort. You worked with Ford, Chevy, Toyota.
Yeah, actually, I'm sorry. It was built in the NASCAR R&D Center.
Yes, yeah.
But collaboration with the three OEMs that are partners with NASCAR, Ford, Chevrolet, and Toyota. So a great collaborative effort to build an impressive piece of technology.
So what's kind of the goal for this? Because when you first see a car like this, your thought is, oh, wow, is NASCAR going to somehow have an all-electric racing system? But that doesn't really appear to be the goal at this point. But they do have broader ambitions for decarbonization, for their own sort of uses, and that's where ABB comes in.
Absolutely. Well, we're exploring what the future of electric racing might look like in the United States, but also you look at the decarbonization and NASCAR's own goals and sustainability goals to reach zero carbon in their operations by 2035. And so while they're committed to the historic roots of the combustion engine in racing, they're also committed to the sustainability goals. And that's where ABB comes in, because we help industries run leaner and cleaner. And so we're going track by track. NASCAR owns racetracks across the United States, and looking at all the ways that we can help their operations run more efficiently and more sustainably.
What if it's leaner or greener? I feel like leaner and greener would have been the case for the last 4 years, but now could it be leaner but not greener? How do you see that evolving?
Well, we say leaner and cleaner, but when you really look at sustainability and efficiency, right? And what you want is, there is a business ROI for efficiency. So sure, we all want to breathe clean air, we all want to drink clean water, and at the same time, there's also a business case to be more efficient and not waste energy. So when you look at a company like ABB, and we look at the bigger picture, because transportation is important to reduce emissions there. But when you look at what's happening in the United States, we're at an inflection point with how we use energy. So when you look at the demand curve for data centers, for buildings, residential, commercial, for factory upstarts. I've seen huge growth in factory upstarts since the pandemic. And the demand curve is there, and we want to do that more efficiently so that as we increase generation across the board.
We're clearly talking about NASCAR, but in general, with your customers and clients, is everyone as committed to electrification and being cleaner than they were a few years ago?
I believe so. I think we're seeing a lot more of I think we need better conversations about energy in the U.S., and that's part of this whole program, right? That's why NASCAR's really helping ABB reach the heart of America. And just to increase better conversations. So what you really see happening in the United States, you have a distributed generation, right? And utilities want a stable grid, but you're seeing multiple sources. And I think we get lured into a false sense of it has to be one type of generation or it has to be another type of generation. When the reality is you have multiple types of generation. And what you really want to do, and what we're seeing companies want to do nationwide, is be able to say, hey, maybe we have a microgrid of clean power, but when the renewable power is not available, then we want to seamlessly switch to the next cleanest form of energy. The good news is we have the technology to do that.
We do. I am curious, though. I mean, just to keep it on cars for a second, because we talk about EV adoption, and there's been a lot of concerns about the cost of vehicles, and more importantly, the cost of the batteries that go into them, but also the range, and then of course, obviously, charging networks, and that's kind of slowed things down a bit. And I am curious as to how that all comes together. When do we start seeing a material drop in the cost of these batteries, but at the same time, a greater efficiency of the batteries, and then kind of fold that into this idea of when can I have the confidence that if I take one of these cars on a road trip, I'm going to be able to power it up, or refuel it, if you will, wherever I need to.
And we get a lot of those questions when we bring the car to NASCAR races, right? And how long can it go? How long does it take to charge? And a lot of things, how fast does it go? Obviously, the performance side of EVs, well known, the acceleration, and this car has 1,360 horsepower, amazing amounts of acceleration. But I think as we have these conversations, the important thing is it gets better. So, battery technology improves. Cars go more miles, not less. Charging times are shorter, not longer. And so as we move year over year, mind you, that the technology is improving. And I think as charging becomes more ubiquitous in the United States, we'll see more adoption.
Have you actually had a chance to actually drive that car? Did they allow you to do that? Because I mean, they showed this car off, and they had on a kind of a drift track. Alex, I know you're a fan of drifting.
Totally.
But it was kind of cool listening to the drivers talk about how fast it can go. I mean, they got up to like 160 miles per hour, which is just a little shy of what a normal ICE NASCAR vehicle could do. Obviously, there's a range issue. I think they said it could only go like 67 laps and not the full 200 that the race requires. But it gets to this idea here that that's still a lot better than what it was, 5 years ago.
Yeah, and I think we haven't tested it at top speed yet, right? We want to make sure we do that. So this is an active R&D project. I mean, all the way down, even the tires made by Goodyear are an R&D project on EV tires. So we're really taking step by step at looking at how fast this car can go and the performance it has on the track. But the great thing is when you start talking to fans about energy and you say, oh, this car would be better on a road course or a short oval where there's braking because there's regenerative braking and it puts energy back in the battery. And that's what we mean by better discussions about energy, because now you're having a conversation about regenerative braking. What does that mean? And what does that mean for your car and how far it can go?
Were you worried at all going into this partnership with NASCAR that you're essentially targeting an audience that to some degree has maybe been a little bit reticent about embracing electric vehicles?
I think that's why it's so important. I think, the energy transition's not just for some people, it's for everyone. And we welcome, ABB welcomes, NASCAR welcomes all opinions. And I think NASCAR's always straddled the historic roots and honoring the historic roots of NASCAR, and at the same time pushing technology and innovation. And I think they have the finger on the pulse to do that.
All right, Chris, we have to leave it there. Chris Shigas, Vice President of Strategic Partnerships over at ABB. Stick with us. A lot more coming up here on the program. This is Bloomberg.
Mag 7 hitting its lowest level since the end of November. That's ahead of NVIDIA's release tomorrow morning. Mag 7 now firmly in correction territory. Bloomberg's Jess Menton is here with us for more. Is this just a Tesla thing? Is it just an NVIDIA thing? Or is all Mag 7 getting hit?
So if you look at where the last high was for the Mag 7 cohort, if you look in the terminal, so it was December 17th. So obviously that was the day before the Fed's decision in December. So you've seen that in a correction, the Mag 7 down over 10% from that record for the cohort. But the most of it has been driven by Tesla. So Tesla's down actually over 35% in that span alone. So then if you compare it to the other ones that are in that, if you're looking at Microsoft, Amazon, also Alphabet, both of them are down. All of them are basically a little bit over 10%, but then Meta's the only one out of the group that's higher in that span.
I am curious, though. I mean, and particularly when we look at the drag from Tesla, not only on the Mag 7, but of course on the broader market as well. Is there any sense here that there could be a reversal? I mean, we're not really seeing the dip buying into that particular stock. You're seeing it in a couple of the other names here. But it seems like, at least for right now, investors seem to just kind of be shying away from this stock.
It's interesting, too, because I was speaking with Emma Wu, who heads derivatives strategy at JP Morgan, and she was noticing based on yesterday's data, the first hour and a half of trading, obviously when stocks were close to their lows of the day, she saw the most selling within the retail cohort on record. So down by $1 billion. But then, so basically traders were selling Palantir as well as Alibaba the most, and Alibaba was coming off of a good stretch on the back of those earnings last week. But then throughout the day yesterday, you saw people come back in and start to buy, but nonetheless, on a net basis, it was still down about $1 billion.
Wow, that's interesting. What about options market into NVIDIA tomorrow?
So that's going to be important because the EE function in the terminal, so we can see the options implied move over one day following its reporting. It's basically NVIDIA stock alone is supposed to swing about 8% in either direction. So if you compare that over the last 8 quarters, on average, it's been closer to about 5%. So clearly the bar, again, being raised here on what they're going to report, because typically we'll see them beat estimates, raise those expectations. We were here a year ago last February. I know a lot of people like to talk about the weakness seasonality more broadly wise, the second half of February, which we are seeing the S&P 500 down month to date. But NVIDIA beat those expectations, but the implied move for the S&P 500 on Thursday, the day after NVIDIA reports, is about 80 basis points in either direction.
Yeah, interesting. Also then what the correlation is to the broader index, a question as well. Hey, Jess, really appreciate it. Thank you so very much, Jess Menton, joining us there. So basically the real event's going to be Thursday morning when we open here.
Yeah, absolutely. And we should point out, I mean, that's the second highest weighted stock in the S&P 500. So you do kind of wonder if they do knock it out the park, is that going to be enough to lift the broader market? And more importantly, if they miss, is it just game over?
Well, or also is it already baked in at this point too? How much of that was baked in after the DeepSeek announcement a few weeks ago? All right,
have you bought any of these chips yet? Any of these Blackwell chips?
Have I?
Yes, personally.
Oh yeah, I have a bunch of them at home, stored in my shoes. Okay, we're about 15 minutes away from the closing bell. Coming up, Megan Horneman is Chief Investment Officer with Verdence Capital Advisors. She'll take us to the close. This is Bloomberg.
You are definitely seeing some signs of a slowdown that we've been anticipating. And when I say that, the economy had been growing close to 3% now for quite a while. We think we're going to see a deceleration into kind of the 2.5% range in the first half of the year, more to a 2.5% range in the second half of the year.
Tony Rodriguez there, head of fixed income strategy at Nuveen, kicking us off to the close, a focus on bond yields as we turn to the equity market. Here's a pop quiz, Alex Steele.
Ooh, okay.
Biggest gainer in the S&P 500 today.
But I know this. Solventum, which is a spin-off from 3M. That's why we weren't familiar with it, because it's a 3M spin-off. But it's sold, it's a purification and filtration business to Thermo Fisher.
So
there we go.
Wonderful. So what does that mean when the leading stock in the S&P 500 is, what do you call that, filtration system?
Purification,
blah, blah, blah.
Spin-off from 3M. It means that tech stocks are not doing well.
Yeah, and you see that
That's
there.
what I'm saying.
When you see that there in the Mag 7, we were just talking about it with Jess Menton, this idea that, we're basically in correction territory. And you do sort of wonder whether the bloom has come off the rose of this trade.
Yes, and when you look at the stocks with Mag 7, you name it, they're all below their 50 and 100-day moving average. There is a ways to go to get to the 200s. The question is, do we actually wind up breaching those levels? I mean, the SOX index is still off by over 2%.
The SOX index is still off. Tesla now looking like it could potentially test that 200-day unless we see a huge reversal over the next few days. Of course, a 9% drop on the day, and I forgot the superlative now. What are we, like a 40% down from the peak or something?
35, I think, from Tesla.
Yeah. All right, let's bring Megan Horneman into this conversation, Chief Investment Officer over at Verdence Capital Advisors, as we count down to the closing bells with just about 8 minutes to go. And I have to get your take first, Megan, here on some of the price action that we've seen over the past few days, because it's a huge turnaround from what we were seeing, even just 3 or 4 weeks ago, when everybody seemed to be thinking that this market could continue to set new record highs. And I don't know what has changed other than just, I guess, a reality check.
That's a fantastic way to put it. Hey, you put words in my mouth. I do think this is just repricing expectations, not only from an economic standpoint, but also from an interest rate standpoint. Coming into this year, late last year, the investors were looking for this perfect soft landing from an economic standpoint. They were looking for the Fed to be flexible with interest rate cuts, and then a seamless transition for the Trump administration. And what we're seeing is that was really, really pricing in way too many too much optimism here. And we saw valuations run up, momentum run up, and this is just giving some of that back because some of those things have really unraveled very quickly. I'm
glad you used the word optimism because we had that Conference Board consumer confidence number come out this morning. That showed a deterioration in consumers, kind of dovetailing with what we saw at the University of Michigan index a few days ago. And it raises the question that as of right now, there really isn't hard evidence that the economy is weakening. But we are seeing in the survey data that people believe the economy is weakening or is on its way to weakening, if you will. You saw that in the consumer index, and you're even seeing that in some of the business the business surveys as well.
Mm-hmm. Yeah, and we actually have gotten some hard data. Now it's 1 month, but retail sales was very disappointing that we got for January. So we are starting to see some of this weakness in consumer confidence, at least that one report filter into spending. And that's why the markets tend to move on some of these confidence indicators, even though they're a survey and you can say, certain biases in some of the surveys. But now we have two really reputable consumer confidence surveys that are showing very, very disappointing data from the consumer standpoint. Typically, the consumer confidence is a leading indicator for spending. So I think that this is going to be a rough first half of the year for consumers. And that's been our biggest concern coming into this year from the economic standpoint. There was just so much optimism that the consumer could just continue to spend on credit cards. Interest rates didn't matter to consumers, and that the Fed would come in and save the day. And we're seeing this is not the case. It's a much cloudier outlook for 2025.
Megan, can we also layer on seasonality around this time as well? January might be good, but then we get into March and we're selling because of tax season, et cetera. Is there a seasonality component here we need to be mindful of?
Yeah, you can always look at seasonality. History tells us February is one of the worst months for the S&P 500. But if you isolate and separate out the first year of a presidential term and what you tend to see in February, it's actually the worst month that you see outside of, I believe, September. And that's telling us that, the new president comes in January. There's a little bit of, euphoria around a new administration. But then February, they kick the ground running with their campaign promises. And we knew that would happen with Trump. So you do tend to see an even weaker February in the first year of a presidential term.
That's such a good point, Megan. So then what do you do knowing all of that? You just kind of sit and hold? Do you want to sell into the weakness, buy into the weakness?
A couple of things that we're looking at doing, obviously, is have extra dry powder, have cash sitting on the sidelines, because even though you're looking at the S&P 500 and that looks like it's been, these point drops on a regular basis, from the peak we've seen only about a 4% downside. So you're not even really in a pullback level here on the S&P 500. In fact, the valuations are still, even with the little bit of weakness we've gotten here, they are quite expensive in specific areas of the large cap space. Look at areas of the market that are being dragged down along with this volatility that we're seeing that are pricing in the expectation for weakness. Look at small and mid cap stocks. They're down between 10 and 15% since, we've reached the 52-week high on those stocks. And they're pricing in the expectation that we have that the growth is going to be weaker, inflation may not be fully behind us, and the Fed's not going to be as flexible. So we think that there's some opportunity from that side in the small and mid cap. And then don't forget to diversify internationally. The U.S. has really led this rally for the past couple years. Yeah. Don't be afraid to look into the developed international side of the market.
I am curious about that. Do you think that trade is sustainable? We've talked a lot about the outperformance of European stocks relative to the U.S. Even some of the stocks in Asia, particularly in the Hong Kong markets, have outperformed the U.S. by a factor of like 3 to 1 here. Is that sustainable?
I think if you take a long-term investment horizon, so don't look at the past few months or even the next 6 months. Look over the long run. When you're looking at valuations in the international market that are historically cheap compared to the U.S., that means that something's going to give. And in our opinion, we think the U.S. is overpriced while the international may be underpriced. This goes the same way with the small and mid caps versus the U.S. large cap. The U.S. large cap is overpriced, and you have the cheaper in that small and mid cap. And you want to look for the long run. We're not day traders here. We're not even looking at the next 3 to 6 months balance and when making investment decisions. We want to see big dislocations in the market, take advantage of them, and then and be rewarded for the risks that we're taking in the long run.
All right, Megan, I have to leave it there. Megan Horneman over at Verdence Capital Advisors. And we should point out, Alex, we did see some dip buyers come in just a little bit earlier in the session, but that's kind of faded now, heading back towards session lows for some of the major indices.
And if we take out yesterday, I mean, these are a couple significant down days since Friday and then today. Also, you have to wonder if we'll kind of continue this until we get through NVIDIA. Yeah, we have obviously a big earnings report tomorrow out of NVIDIA. We get a few earnings after the bell tonight, not as consequential, but certainly could move the market into it. Workday, Instacart, AMC, Kava. Caesars. Are you a gambler? Amazing, right? Yes. You
Snake
love
eyes?
the gamble. Love the gamble. Texas Hold'em.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through that closing bell. A global simulcast, it starts right now. Scarlett Fu in the TV studio. Carol Massar and Tim Stenevec in the radio booth as we welcome our audiences across all of our platforms, including our partnership with YouTube. And Carol Massar.
What?
Jeez, guys.
Most stocks. I know. Wow, she's really on it today.
Well, Alex,
the market's holding up. But look, we're only down 0.4% in the S&P. We should point out the Nasdaq taking it a lot harder here on the day. But we should point out, at least in the S&P, the majority of stocks, Carol Massar, are in the green.
Yeah, which is what I always like to go to, right? Like we have these major indices. It's one number, but if you dig a little bit deeper, I was going to go. Alex, I've heard about your gambling problem.
Okay, it's just Ultimate Texas Hold'em. That's it. That's my jam.
That checks out. I like that. Anyway, no, she has no gambling problem. We overheard you guys going into the close, so it was kind of fun to hear your conversation.
One problem that we could be
Caesars.
seeing right now is consumer confidence. The conference board this morning releasing that data. Yeah, you guys like that?
Yeah, that was a real sweet segue there.
Yeah.
Out of context comments are the best.
I'm being told to stay on task, guys.
No, actually, we're listening to you guys chat when Tim's like, it sounds like you and me kind of chatting, like the same thing. It was
Carol was telling me about the way she likes Egg McMuffins. So
no
Really?
cheese.
Buy Egg McMuffins?
Wow.
That's impressive.
They're now $1. They have a promotion.
Yeah,
they're not
big
gonna.
spender.
They're not gonna spend more, cause you to pay more because of the eggs. McDonald's.
All right, we are getting the closing bells right here in New York, and as obligated, you're required to clap here, whether it's an up day or a down day. There is some green on your screen. You'll find that in the Dow Jones Industrial Average, up about 160 points or so as we wait for these numbers to settle. That's going to be good for a gain of about 0.4%, and that is pretty much your bright spot. The S&P 500 back below that 6,000 level, down 28 points or 0.5%. The Nasdaq down more than 1% here on the day, and the Russell 2000, Carol, lower by 0.4%.
All right, we said earnings after the closing bell. We talked about gambling. Caesars Entertainment coming out with their numbers. Fourth quarter EPS, 5 cents a share. We're looking at fourth quarter same-store net revenue at Caesars of $2.8 billion. That's a little light, but pretty much in line, $2.82 billion. And fourth quarter net revenue of $2.80 billion. Fourth quarter same-store adjusted EBITDA, $882 million. That's a little light. $902.9 million is what the street was looking for. And just pulling it up on my Bloomberg, because we know Caesars is up about 5% here in 2025. I'm not seeing much movement here. It looks like the stock is unchanged in the aftermarket.
All right, you're looking at Caesars. I'm looking at Intuit. Shares unmoved in the after hours. The company coming out with its guidance saying that it still sees fiscal year adjusted operating income at $7.24 billion to $7.32 billion. Still seeing fiscal year revenue $18.16 billion to $18.35 billion. The estimate was for $18.28 billion. Just reiterating that fiscal year guidance. Second quarter adjusted EPS coming in above estimates at $3.32. Second quarter net revenue coming in at above estimates as well, $3.96 billion. All
right, let's move to the software sector. Workday coming out, the enterprise software company, reporting fourth quarter revenue, topping analyst estimates, $2.21 billion in the fourth quarter, higher than anticipated. Fourth quarter adjusted EPS of $1.92, also higher than the consensus estimate of $1.78. The company talking about fiscal 2026 subscription revenue representing a 14% growth and giving a operating margin for fiscal 2026 of about 28%. That stock up almost 5% in after-hours trade.
All right, I'm taking a look here at Grocery Outlet. For its fourth quarter, net sales came in kind of bang in line with estimates at $1.10. Taking a look at their 2025 potential, their comp sales are 2 to 3%. That's, again, bang in line with estimates, and their net sales on the high end, they see about $4.8 billion. So relatively solid when it comes to Grocery Outlet, but that stock is down by about 5%. I was trying to look through the release just to see if there's anything about, say, egg prices, inflation. I haven't been able to find that yet, but they do talk about key strategic initiatives that they're taking to help their foundation and future growth.
I'm looking for the same thing out of Jack in the Box. Not quite seeing it here, but the main headline on that company, the fast food chain, out with earnings, and also saying that its CEO plans to depart. CEO Darren Harris has apparently accepted a position outside of the company. He has resigned. The CFO will be in place as the interim CEO as a search for a permanent CEO. As for the earnings themselves, the company basically says that in the first quarter, it did see operating EPS of about $1.92 a share. That is a beat. Street was looking for $1.70. The company also saying here that on restaurant level margins also came in well above Street estimates at about 23.2%. Street was looking for roughly about 20%, guys.
All right, off to Instacart I go, and you can see this stock already down a bunch in the aftermarket. Let's go to the outlook. Sees first quarter adjusted EBITDA of $220 million to $230 million. The estimate on the Street was above all of that, $237.1 million. You're seeing Instacart down about 6%. Also sees first quarter gross transaction value $9 billion to $9.15 billion. Just going back to the fourth quarter, so the last quarter, fourth quarter adjusted EBITDA of $252 million. That is above the Street estimate of $239.6 million. Fourth quarter total revenue, that's a little light, $883 million versus an estimate of $890.9 million. And then again, fourth quarter orders, again, looking backwards, $77.5 million. That is above the Street estimate of $75.9. But nonetheless, the outlook is why his stock is down 6% in the aftermarket.
Digging into the fourth quarter 2024 shareholder letter for Instacart, the company is saying that online grocery is outpacing in-store grocery growth by more than 3x, making this a pivotal moment for grocers to compete digitally. With high fixed costs and low operating margins, winning a point of share can drive incremental profit dollars and margin expansion for grocers. But the vast majority of grocers don't have the tech, time, or resources to adapt alone. They need an ally. Obviously, Instacart wants to be that ally.
We need to go down to Washington. Some breaking news there. The President of the United States signing new executive orders, one on healthcare, one on copper. The healthcare executive order, in his words, is about price transparency in healthcare. We're going to have to get you some more details on exactly what that means. The President also in the Oval Office signing a separate executive order on copper that, in his words, could lead to copper tariffs. And Trump, in his words, saying that the copper order will have a big impact. We'll have to keep an eye on that. Of course, right now, the main spot markets for copper are closed. But, of course, once that opens, we'll see if there's movement there, guys.
Yeah, looking at the futures market, we are seeing some movement on that. Just real quick, First Solar, they're coming in. They're missing their estimates for the fourth quarter, coming in $3.65 a share. Their net sales, though, a little better than estimated, coming in at $1.51 billion. They see their total net sales for this year on the high end, about $5.8 billion. That definitely beats estimates. So watching that as we head into a different kind of administration. Operating expense anywhere from $470 to $510 million for the full 2025, guys.
Okay, Lucid, the EV car maker, the luxury EV car maker, also coming out with results. Fourth quarter adjusted loss per share was 22 cents. That was narrower than what analysts had been anticipating. It also announces a CEO transition with Mark Winterhoff named interim CEO. Overall, the adjusted EBITDA loss for the fourth quarter of $577.3 million was slightly higher, slightly larger than what was anticipated. In terms of the outlook, we're just getting bits and pieces here. 2025 production will be about 20,000 vehicles. Again, this is Lucid. The stock currently up almost 11% in after-hours trade.
All right, I do want to go back to those executive orders that President Trump is signing right now in the Oval Office, and specifically the one on copper. I'm not exactly clear what the impetus for this is, but he's basically saying that this will effectively launch a Commerce Department investigation that could lead to tariffs on copper. And I guess I am curious as to how this folds in with some of the other tariff announcements or pronouncements that he's made so far on some of the other commodities out there.
Yeah, he talks about it being a probe into derivative imports for copper. So I wonder if it's very targeted. But look, if you're going to tax copper, steel, and aluminum, how are you going to build anything? I mean, everything's just going to be really expensive to then import and build.
I guess the whole idea is to use American-produced materials, right? But Alex, I mean, you know this world so much better than I do. Do we import a lot of copper, or is what's the market look like?
I mean, a lot of the copper winds up coming from South America, for example. We still have copper here for sure, but Canada also has some in South America, so you got to import it no matter where you go.
Yeah, this copper investigation or probe is supposed to be based on national security, not trade imbalance. Just looking at copper futures here in the aftermarket, up about 1.2%. So yeah, we'll look for some more details on this, but bring up some really good point, right? If all this stuff is so expensive, how do you build anything here in the United States? So questions to be answered. All right, guys, busy aftermarket news flow, no doubt about that. Our cross-platform on radio, TV, YouTube, and of course, Bloomberg Originals. We call it the closing bell. Alex is heading out. She's going to find out more about this copper. I know she will. And of course, Romaine and Scarlett continuing on TV. Tim and I continuing right here on Business Week.
Stick with us. A big conversation up ahead about food inflation. We're going to talk to Tom Flocco. He's the CEO of Pete & Gerry's, the owner of the largest organic and free-range egg brands in the country. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. Economic jitters really took the wind out of the sails of the market today. Stocks right now at a 5-week low at the close here, and that was led down by the Magnificent Seven, a huge drop in Tesla, a huge drop in NVIDIA ahead of a consequential earnings report, and the risk-off trade you can really see reflected in that drop in Bitcoin. The iShares Bitcoin Trust down 6% on the day.
All right. And of course, we're keeping an eye on after hours earnings. The latest across right now is Cava, the restaurant company, reporting fourth quarter earnings per share on an adjusted basis, missing the average analyst estimate, 5 cents for the fourth quarter. Revenue also coming in higher than anticipated. But again, that bottom line misses. In terms of fourth quarter restaurant comp sales, that was 21.2%. That was higher than anticipated. And when giving an outlook here, Cava saying that 2025 restaurant comp sales will be anywhere from 6 to 8%. The midpoint of that range does miss the average analyst estimate, which is 7.85%. You're seeing Cava shares down about 9.5% right now in after-hours trade.
Second biggest decliner in the after-hours trade. I do want to just turn real quickly to the semiconductor space. On Semi, out with a statement saying that it is announcing a restructuring plan that intends to cut its global workforce by about 2,400 jobs that it says will save it about $105 to $115 million. That does not sound like a lot and is not moving the stock, but this could have some interesting implications heading into that big earnings report out of NVIDIA tomorrow, of course, which will give us a closer look at the AI trade and, more importantly, on the health of the chip sector. I mentioned Cava, the second biggest decliner in the after-hours trade. Instacart, that's your biggest decliner, down 9.8%, a miss on revenue in the most recent quarter. Mandeep Singh joins us right now of Bloomberg Intelligence here. They're still generating a few $100 million in revenue, but is not what the street was looking for. And I do wonder what the future holds for this company. Are they able to compete in this space as a grocery delivery company?
Yeah, so what we have seen so far is this field is consolidating. And right now you have the two scale players in Uber and DoorDash when it comes to food delivery and grocery delivery. Instacart is pure play grocery delivery. And that's where the challenge is for the likes of Instacart as well as Lyft. When you are so niche focused, and you don't have the scale. I mean, look at the number of orders for Instacart versus a DoorDash. DoorDash has almost 10 times more orders in a quarter.
Wow.
So that, and because they have bundled food delivery, grocery delivery, and now they're selling your DashPass subscription, which is like your, Costco subscription. And you will end up consolidating into either getting one subscription, whether it's Uber or DoorDash, but you're not going to get all three.
Now you are a super subscriber at Costco. Are you a super subscriber
I am a super subscriber at Costco,
Yeah.
but no, I hate DoorDash with all my heart because my children order too much from it. That's the main reason why. But to your point, Mandeep, does Instacart need to branch out into new revenue streams? Can it do that, or has it all been taken up by the big players?
Actually, they were the pioneers when it comes to layering ads on their marketplace. So they were probably one of the first ones to successfully, add an ad business, and it's almost 30% of their overall revenue. And they are able to show you ads kind of depending on what you put inside your cart. So it's really targeted ads. But with that being said, in any sort of marketplace, if you can't grow, number of users or number of orders, it peters out. That hurts your ability to, grow the scale of your marketplace. And that's the challenge that Instacart has in terms of either they decide to expand into newer categories like food delivery or ride sharing. Otherwise, how else do you grow the scale of your marketplace?
Well said. Mandeep Singh of Bloomberg Intelligence, thank you so much. Instacart, of course, a big decliner here in after-hours trade.
All right,
Remy?
well, that conversation made me a little bit hungry, so let's take a look back at this day in history. 50 years ago today, when McDonald's officially rolled out the Egg McMuffin breakfast sandwich, all of its restaurants worldwide across the U.S. And it proved to be a revelation for the fast food industry, which at the time was heavily skewed to lunch and dinner customers. But there was a man, Scarlet Fu, his name was Herb Peterson. He's a hero. And he had an idea. He wasn't a cook and he had no background in restaurants. He was an ad man. And in the 1960s, he helped manage DRC Advertising's biggest account, which was McDonald's. And Peterson, who actually helped to create the Ronald McDonald mascot, he was so taken by this fast-growing fast food chain, he decided to become a franchisee himself. He opened locations around the greater Santa Barbara, California area all across the 1960s and 70s. And during that time, he noticed something funny. Customers were showing up to his restaurants well before the 11 a.m. opening time looking for a meal. So Peterson thought, what could he offer them for breakfast that would have the same handheld convenience of a hamburger? Menus at McDonald's at the time were very sparse, just hamburgers, fries, apple pies, and fountain drinks. But Peterson saw an opportunity to broaden out, taking his favorite breakfast food, Eggs Benedict, and turning it into a sandwich by replacing the hollandaise sauce with a slice of cheese and swapping in Canadian bacon for the ham. And here's a fun fact. During this development process, he consulted with none other than California native Julia Child, who was busy with her own burgeoning food empire out east. Now, the McMuffin went through several years of testing before being rolled out nationwide on this day back in 1975. At the time, it was served with jam or honey. And the McMuffin instantly boosted sales and prompted executives at McDonald's to experiment with more diverse menu items like hash browns, like Danishes, even fruit juice. And it all forced other competitors like Burger King to enter the breakfast market as well. Today, breakfast accounts for about 25% of McDonald's store sales, with the company saying it has to buy around 2 billion eggs, billion with the B, each year in the U.S. to fuel those appetites.
That number is staggering, and I can't believe Julia Child contributed to the invention of
I know, who knew?
Okay, well, speaking of eggs, you could say consumers are cracking under the pressure of rising costs. I know. The average wholesale price has doubled to a record $8.07 a dozen from mid-December. And of course, that's due to a shortage driven by the worst ever bird flu outbreak in the U.S. Joining us now with his expertise is Tom Flocco. Tom is the CEO of Pete & Gerry's, which offers organic, free-range, and pasture-raised eggs. Tom, good to speak with you. Your eggs are a premium product and command a higher price than commodity eggs. What's been the direct and indirect impact from this current bird flu outbreak on your eggs?
Yeah, good afternoon. Thank you for having me. It's probably important to start with just an understanding that there really are two separate egg segments out there. There's what we call the commodity eggs, which are caged and cage-free, that are really feeling the brunt of the inflation that we're all experiencing out in the grocery stores. And that is, as you said in your introduction, a function of the fact that over 30 million birds have been culled from the supply chain in the last 6 weeks or so, and certainly more than that over the course of the past year because of avian influenza. That has driven the price up. Those eggs are priced based on Urner Barry, which is an independent index, and that has skyrocketed over the course of the last 6 to 8 months. Our eggs, Pete & Gerry's and Nellie's, which are of the specialty segment, different than the commodity, are actually the same price today as they were a year ago to the retailer. So we have not raised price to the retailer. We have a set price, just like most other consumer products items, and we've kept that price steady. We are not subject to the same supply and demand dynamics as the commodity players. So that's what we're seeing. So our eggs, in some cases, our eggs are actually lower priced right now
I was just
on the
gonna
shelf
say.
than the commodity egg.
Absolutely. Yeah. It would be cheaper than a lot of the eggs out there. It may not have a direct impact on your pricing, but doesn't the shortage of eggs, commodity eggs, have an impact on demand for your eggs?
Absolutely, because that's why we're called specialty eggs. Consumers, there's typically a $3 to $4 price premium on our eggs. So there are consumers that believe in hen welfare, that believe that that leads to a better product as well as a happier bird, and they're willing to pay that premium. Today, when that premium is gone or almost gone, it's a lot easier for consumers to reach for the premium product. They experience our product and realize that it's better than the commodity egg. And in a lot of cases, our studies show that they don't go back. So yes, as soon as our eggs are hitting the shelf, they're gone. And we're doing our best to keep up. Unfortunately, this is a fairly long supply chain to correct. It takes about a year to bring hens on a new barn on with a new farmer. And we're doing that on a rapid pace, but it's just very hard to keep up given the demand dynamics right now.
I am curious, though, about the bird flu, the avian influenza. You mentioned the 30 million birds or so over just the last few weeks. I think I saw a number, something more than 100 million since the bird flu was first identified back in 2022. Why has that not affected your farms in the way that it's affected others?
Yeah, so that gets back to the difference in the supply chain model. So we work with small family farms. Our farms are spread out over 15 states. We have close to 300 of those family farms. They are family farms, so people are not coming on and off property. And the birds are very well insulated from just the dynamics around them. They tend to be smaller barns. We have more barns with fewer birds, so we're dispersed from the risk. The barns that the complexes really that get hit hard are the caged and cage-free players. And cage-free birds do not get outside. Free-range birds like Nellies do. And when you have campuses that have hundreds of thousands and potentially millions of birds, when you hear about millions, 1 million, 2 million, 3 million birds being taken out, that's when a campus gets hit. And avian influenza is such a virulent strain that it spreads very quickly and will unfortunately infect all of the chickens. So you have massive numbers taken out of the supply chain, and that's really what we're having a hard time keeping up with.
I am curious just about consumer sentiment overall, even if this doesn't affect your brands specifically here. There's been so much focus on this by consumers, and I do wonder if you worry at all that demand overall for eggs could actually go down as people sort of look at prices and then maybe find alternative ways to eat breakfast or do whatever they were doing with eggs. Is that a worry at all for you?
We don't worry too much about it, again, because we've kept our pricing consistent. So we're offering that value to the consumer today. And we're hoping that they realize that eggs are still nature's perfect protein. It's still a superfood that consumers can have for breakfast, lunch, or dinner, and is still on a gram for gram basis a better value than really any other source of animal protein out there. So while it's more expensive now in the commodity area, it still represents a value at $6.99 or $7.99, which is what you might pay for one of the Pete and Gerry's brands, or $5.99 for Nellies if you see that on the shelf.
All right, well, that's a price I can live with given what I've seen on the shelves as of late. Tom, great to talk to you. Tom Flocco, the CEO of Pete and Gerry's. As of everyone out there, everyone who's gone to a grocery store is right now focused on the price of those eggs and really just the availability of those eggs as well. And some people are actually just deciding to take matters into their own hands. Let's bring in our next guest here. It's a company called Rent the Chicken. It lets customers rent hens along with all of the supplies required to maintain the chickens, like the coop and the feed. In turn, customers can expect to receive between 8 to 28 eggs per week. Jenn Tompkins joins us right now. She's the co-founder of Rent the Chicken. All right, this is an interesting concept. I'm not in the market for it because I live in a New York City apartment. But for those of us who have the space and maybe the willpower to do it, I mean, how easy is it, Jenn, to get something like this set up?
We make it so easy. Honestly, we have this top 10 reasons to rent the chicken that comes out every spring. And spoiler alert, we make it easy is one of those top 10 reasons. So,
so just explain. So if I contact you, you're going to give me the coops, the supplies, everything I need to sort of get things up and running. And just forgive my ignorance here. I'm just, a poor city boy. But like, when did the chickens start giving me my eggs?
Great question. We provide a portable chicken coop with 2 to 4 egg-laying hens. The rental is from spring until fall, so think April through October or May to November. 2 hens lay about a dozen eggs a week. We plan our rentals for April in September or October, so we buy our baby chicks then or hatch our chicks then, and they are ready to lay come springtime. So they should start laying within a few days of delivery. Sometimes they lay when we're on our way.
So Romain goes on vacation a lot. He might not always be around to feed his chickens or the hens. How much maintenance is involved in this?
We ask that the portable coop is moved once a day and that the chickens are provided with their food and water, and then the eggs are collected. He seems like a pretty friendly guy, so most times a neighbor doesn't mind checking in on the chickens to collect the eggs.
So what kind of demand have you seen since the outbreak of this bird flu in late 2024 and early 2025? What's been, the take-up on Rent the Chicken?
Our phones are ringing like mad. Our online inquiries are filling up quickly. Our rentals are up this time this year compared to last year. Now, keep in mind, we made the decision last fall what our prices would be for this year and what our availability would be. So we will run out of inventory, and in my world, that means we'll run out of chickens.
So have you not been affected at all by by this avian flu at all? Has that not affected your business?
Oh, it affected our business because people really want to be closer to their food sources. Our renters don't have to worry about the price of eggs, and they don't have to worry about any food shortages, like egg shortages or egg restrictions at the store. So that's the kind of impact that we have seen in regards to avian flu, because people really want to know where their food's coming from and be connected and not be impacted by these circumstances.
And Jen, forgive me for asking a really dumb question, but if I were to get Rent the Chicken, how would I prevent my chickens from getting the avian flu?
Oh, great question. We have major biosecurity measures in place, even when there's not an avian flu outbreak. And most times the avian flu is transmitted, if I understand correctly, through wild waterfowl. And a few things. They're usually done going wherever they need to go to or from by the time we deliver in April or May. The next thing is most of our renters don't have like geese or ducks traipsing through their properties. And we always recommend, of course, hand washing. We want to make sure everyone wears their chicken specific shoes for their own chickens and not let other people into their chicken runs and those kind of things.
Chicken specific shoes. Okay, these are things that you need to keep in mind then. Jen, really appreciate your joining us today. Jenn Tompkins is co-founder of Rent the Chicken, and Romain, she says their phone is ringing off the hook.
And just make sure, Scarlett, you get the hens, not the roosters.
Yes,
I made that mistake, and my neighbors never forgave me.
And you didn't get your eggs on top of that.
No.
All right.
They're horrible.
I know. And you were wondering what happened. You couldn't eat your Egg McMuffin, your homemade Egg McMuffin. All right, let's get you some more results. Boston Beer, ticker SAM, reporting results. In terms of fourth quarter, it had net revenue of $402 million. That was higher than anticipated. The loss per share was $3.38. That was wider than the anticipated $1.56. But when it comes to the full year outlook, it sees earnings per share of $8 to $10.50, and gross margin will be between 45 to 47%. Romain, the consensus estimate is 45%. So higher than anticipated gross margin for 2025.
Yeah, not too bad. Of course, we have some even bigger earnings coming up tomorrow that could really move this market.
Yeah, the Magnificent Seven also dipping into correction territory. So that puts the onus on NVIDIA to really deliver. The question is, have expectations come down far enough?
Yeah, that is a big question. We're going to try to get some answers out of Kristin Roth DeClark, Global Head of Technology Investment Banking at Barclays.
The Mag 7 plunging into correction territory, meaning it's dropped just over 10% from its peak in December, which makes NVIDIA's quarterly earnings due out tomorrow all the more timely. Joining us now to discuss what's at stake is Kristin Roth DeClark, Global Head of Technology Investment Banking at Barclays. Kristin, great to see you. And I kind of want to set the scene first because there's a big question about whether expectations and sentiment has come down enough that another blowout earnings report from NVIDIA, and that's what it usually delivers, would be enough to turn the tide, the negative sentiment tide.
Yeah, so we see this almost every quarter leading into earnings recently, that the stocks that are trading at relatively high valuations come in a little bit ahead of earnings. We have the added complexity of some recent headline volatility around economic data and such that I think is compounding that a little bit. What investors are looking for as over the next week, as we have some real bellwether tech earnings, are going to be a couple things. One is, what's the growth driven by AI? And then a number of these companies have had new product announcements over the last 1 to 2 quarters and how that is translating into revenue. On the constructive side, competition is going to be the most important piece, together with any guidance around tariffs and supply chain implications.
Which, of course, everyone is reluctant to give because they don't know what's going to happen. What we've learned this earnings season is that hyperscalers are still very committed to spending tens of billions of dollars to build out their AI capabilities. Now, with the unexpected success of the Chinese AI model DeepSeek, investors are less comfortable with that level of spending than they were before. Do you think NVIDIA's results and the other results this week will change that narrative at all or add to that narrative?
Well, look, I think every tech company is trying to figure out how much CapEx is going to be required to meet the needs of the explosion of AI. And we're going to see varying levels of that, whether it's investment to fuel the LLMs or it's investment to support the smaller models and just that are being used with increased frequency. We're going to see that investment continue. And so I think it just varies by company.
Will that investment, though, maybe be a little bit more targeted? Is it going to shift at all? I mean, even if the aggregate amount is the same, because it seemed for a while this was literally just people throwing spaghetti at the wall. I mean, if you had the cash, why not?
Yeah, and I think you're right. I think there is a little bit of a mix shift that will happen between now and the next 5+ years as we see this build out develop. But it is still, I mean, I think it's just a massive opportunity.
Are people talking about kind of the end use cases, though? Because there was some interesting commentary that Satya Nadella made over at Microsoft. I guess he was at a conference or somewhere. And he was kind of talking about this idea that we still kind of need to see more of the use case for a lot of this stuff. Like, everyone's experimenting with it, they're building data centers, but the end result of it all, meaning the final customers who buy that, whether it's a business or a consumer like ourselves, when is that use case going to be a little bit more apparent, or are you seeing it already?
I think we're starting to see it as it relates to some of the agentic AI, some of the revenue growth, and hopefully we will see that, continue to see that through the cycle of earnings. We saw it first on the cost saving side, so margin improvement in some of the businesses using AI for cost saves. Now the next leg is really, where do we see that in the top line growth?
But on the agentic AI, and this has been, we've heard a lot of people talked about it, and I think we get Salesforce earnings tomorrow as well, which is going to kind of get lost in the shuffle of NVIDIA. But obviously they've been banging this drum for a while. Is the adoption there right now by corporate customers for this, or are they still kind of waiting and seeing?
I still think it's early stages, but there is an opportunity for this to start to show up in numbers, and that's what investors will be looking for, or in guidance.
You're a global head of tech investment banking at Barclays, so we have to ask you about M&A as well. There was a lot of excitement when Trump was elected that they're going to be much more open to mergers and acquisitions, not just in the tech industry, but across the board. But then we saw that the DOJ, under Trump, has sued to block HPE's $14 million deal to buy Juniper Networks. Can you reflect a little bit on what that means for any company that's interested in making a deal? What signal does that send?
We came into this year as an industry, I think, slightly more optimistic than some of the recent commentary has suggested around the regulatory environment for M&A. That said, I think combinations where there is incremental technology, so where there's companies buying either data sets or a data solution or an AI solution to fuel growth, but not necessarily the 3 companies to 2 companies type mergers. That's where the real transformational opportunities are. We've also, this year, even though M&A volumes are down, we've seen a 20% increase year over year in M&A for $5 billion and less market cap companies. Some of that's driven by sponsors and take privates. The last piece of M&A where I think M&A will be fueled is with the increase in activism that we've seen over the last year. There will be some M&A catalyzed in the form of divestitures, I believe.
And which sectors would that, within tech is most vulnerable to that, do you think?
In which case, on the
activists and then divestitures,
That's kind of across the board. I mean, we've seen an increase in activism by about 6% in the last year in terms of the number of campaigns in the U.S., but 25% of those were targeting technology companies. We've seen that in software, we've seen that in semis, we've seen it a little bit across the board in tech, just depending on the company.
All right, Kristin, we have to leave it there. Kristin Roth DeClark, Global Head of Technology Investment Banking over at Barclays. Here, a closer look here at some of those tech earnings that we're going to get tomorrow, Scarlett, but we are getting some earnings here right now in the here and now.
Yeah, let's start with Caesars. Caesars Entertainment reporting fourth quarter same-store sales, comparable sales, same-store adjusted EBITDA missing analyst estimates. That stock down by more than 3% after hours trade. AMC, the meme stock, also reporting results. Do meme stock companies' results matter?
Well, it depends. Are you a believer in the meme?
Well, I mean, you're asking the wrong person. But fourth quarter revenue meeting analyst estimates. Fourth quarter adjusted loss was 18 cents a share. That stock higher by almost 4%.
Yeah, I also want to take a look at Land's End. This just crossing the wire right now. The company is saying that it received a letter from activist investor Eddie Lampert, who is apparently asking for the company to initiate a strategic sale process to maximize shareholder value. And you bring up Sears, of course. Yes, there is a connection there. And of course, Land's End has a connection to Sears. So it's all very all very entangled here. But he's basically asking for a strategic sale process. Remember, this is a stock that's down like something like 80% from its all-time high. So not a big underperformer.
Okay, and also Axon Enterprise, which is a defense company, coming out with results as well. That stock up by almost 11%. There you go.
Yeah, they make tasers and surveillance equipment and a lot of stuff being sold to law enforcement there. Here, a big beat on the top end, bottom line.
This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Billy McFarland, better known as the man behind Fyre Fest. He has actually not given up on a second iteration because, Romaine, tickets for Fyre Festival 2 are on sale now.
What's the phrase? Fool me once, shame on you. Fool me twice, shame on me.
Yeah.
Look, if you want to take another chance on Billy McFarland and the Fyre Fest, then
go for it.
Be my guest. I got to give the kid, some props for continuing on.
Yeah, he served 4 years for fraud for the original one, and he's back at it again.
All right. Well, I'm not going to be there, but we will be keeping an eye on that. I'm also keeping an eye on Brian Moynihan. He's the CEO of Bank of America, and he had a chance to sit down with David Rubenstein a little bit earlier in a peer-to-peer conversation where they talked about a wide range of issues, including U.S. bank regulation.
The day-to-day regulators are trying to help us be better, and we understand that. We are on the road to perfection as a company. And as Vince Lombardi said, you strive for perfection, excellence to be found. That's what we're trying to do. If they've got ideas, we're all ears. Simplifying the organization will allow, frankly, cost to be taken out from the regulatory side, and we pay fees to support it. And it wouldn't be the worst idea.
One of the longest serving major CEOs out there, and you can catch that full conversation with David Rubenstein on the David Rubenstein Show, Peer-to-Peer Conversations, which airs March 12th at 9 p.m. New York time.
All right, and in terms of number 3 on the docket, Doug O'Donnell. He's the IRS acting commissioner. He's going to retire after almost 4 decades of service at the tax agency. That's according to sources. His last day will be February 28th, which basically comes in the middle of tax filing season.
Yeah, interesting timing. For personal reasons, do I still have to file taxes? I don't know. But it gets to the broader question.
You're always
here.
ahead. I know you've already done it.
It gets to the broader question about who's actually running these agencies right now, with all the chaos, of course, with Doge and Elon Musk coming in and firing workers, and some of the agency heads basically just saying, I don't really want a part of this. And of course, he was already interim. So
exactly.
It raises a lot of question who the permanent replacement will be. Let's bring Kim Wallace into this conversation. He's Senior Managing Director and Head of Washington Policy Research at 22V Research. And Kim, I do want to pose that question to you because amid all this noise going on in the Trump administration, we kind of forget there are a lot of critical agencies right now that either don't have a head or at least don't have a permanent head. And I guess I'm wondering, are these positions going to be filled?
Hi, Romaine. I would think, and hello, Scarlett. I would think that they'll be filled and likely to be filled relatively soon, that meaning in the next 3 to 4 months. I'm not sure that the confusion, the chaos that's going on at the agencies is going to ebb in that time frame. But a couple of minutes ago, a district court judge in D.C. put a longer freeze on the firings and on the freezing of funds, you're beginning to see the outlines of how some of the uncertainty around agency governance might either abate or come in.
But is the damage done, Kim? I mean, we talk about, and I don't know whose numbers to believe, but you talk about the number of workers that have either been fired or have voluntarily left or accepted buyouts in some form or fashion. So even once the courts do get around to maybe potentially putting a stop to this, I mean, what's going to be left, Kim?
Well, there'll be a lot left. It's the federal government. I think part of your question, Romaine, is to what effect has all of this falderall been? My guess is once we get through this, there'll be a lot less savings achieved through this process. There'll be a lot less restructuring of government through this process. Those two objectives are commendable. Obviously, as large as the federal government is, it's nonsensical to think that there can't be improvements in efficiencies. It's the manner in which you do it, and usually you have to go through the legislature to achieve that, or through executive action that is publicly commented on and then goes through a process. My guess is we're headed back to something closer to that. But yeah, damage will have been done. You certainly have already discouraged maybe some of the best and the brightest in the federal government who were there for various reasons, certainly not pay, who've decided it's just not worth it.
But the Trump administration seems intent on proving that there's a lot of bloat in the federal bureaucracy and that some of the jobs don't require a full-time person. There's a lot of Trump officials doing double duty. Doug Collins, for instance, a congressman who's the acting leader of the Office of Special Counsel and the Office of Government Affairs, he's doing that in addition to Secretary of Veteran Affairs as well. How does that compromise each of the government agencies to have people taking on a second or third job?
Well, the specifics are hard to know unless you're inside those rooms or the decision making, and I am not. But those are three meaningful jobs. You obviously want to hire a team that will help you manage. That happens with all principals at agencies and bureaus and departments. But given that this is, you're going into the second month of the second term for the president, it is difficult to imagine that a person can manage all of those objectives and all of that staff and all of that budget simultaneously.
I want to pivot here and talk about Congress and what they need to do. The House has already started debate on the budget resolution, and my understanding is something could even happen by tonight. How critical is this, or how much movement do you think this bill will have?
Speaker Johnson is going through the same process that he went through a couple of times last year and that the speakers before him went through. You have very tight margins in the House. And in this Congress, the margins are even tighter until around April, when some of the seats that are expected to be vacated will be filled. But it's tough. And the budget resolution is an important step in the broad blueprint. What's important out of the budget resolution, if you're going to have large savings or tax cuts, is to have a reconciliation set of instructions sent to various committees. That's what's contained in this budget resolution. So whenever they get around to passing the resolution, and they will, whether that's tonight or next week, they'll pass it eventually. The real action and risk will be, how do the individual committees come up with their savings? Is there really $880 billion savings in Medicaid over 10 years or not? And if there is, how will the Energy and Commerce Committee write the law to come up with that savings? That's where, as I said before, the action, but really the risk comes. This is an initial step. There'll be many others after that. Fiscal policy is going to be a year-long nemesis for leadership. And it usually is, but particularly when you're trying to move large objectives.
Right, very well said. A year-long nemesis. Kim Wallace of 22V Research. Thank you so much. And the headlines from Washington keep coming fast and furious, but it's hard to kind of make sense which ones really have lasting impact versus are part of the negotiations. Yeah, absolutely. Here, I just real quickly too. I just want to point out Super Micro shares up 15% in the after-hours trade. Remember, they were in danger of being delisted because of its lack of filing its SEC forms. It has now filed that 10K to the SEC, something that's been long awaited. They were up against a deadline that could have actually had them delisted from the NASDAQ. All right, a lot more to talk about here on the show. Valentine's Day may be behind us, Scarlett, but it's still never too late for you to get me a card. The sentiment to spread love, it still lives on, and we're going to talk to the founders of the Black-owned card brand Neighborly Paper. That's coming up next on The Close on Bloomberg. All right, we are keeping an eye on earnings. We get some more tomorrow out of Urban Outfitters and TJX. The results expected to unveil a strong turnaround from the 2024 holiday shopping period where consumers bought everything from clothing to greeting cards. And that includes the ones designed by Neighborly Paper. It's a Black-owned and female-founded business that designs witty and unique cards for various occasions. The cards are available at Urban Outfitters, Paper Source, Home Goods, and elsewhere. And I'm pleased to say that the founders join us right now, Robin Beck and Carmelle Kendall. All right, so this isn't a joke, but so a writer and an illustrator walk into a bar, wherever you guys met here, and somehow you guys decided that you wanted to create a greeting card business. Is that how it started? I think we're having some issues with their audio, but you know, I don't know if you've seen these cards, Scarlett, but you know, it's you know, they're very cute, and you know, it's like if you're looking for something that's a little bit different and something you know, you want to impress your spouse or your significant other, anything else. I think we have their audio back. Hey guys, sorry about that. I think we had some audio issues, but go ahead, just kind of tell us how this all started.
Yeah, hopefully you can hear us okay. Carmelle and I grew up as neighbors in Atlanta.
All right. Yeah. Sorry. So we're having a little bit of a problem with their connection here. We'll try to sort of hook them up and hopefully get them back on here. But it gets to this idea too of kind of new brands really trying to find sort of a place in the world, and it's hard, right? I mean, you start something. I mean, who's going to buy it? How do you get an Urban Outfitters or a Home Goods or TJX to take a look at you and hopefully put you on the shelves?
It's all the more impressive because they have found their way into these national chains, right? Whether it's Paper Source, as you mentioned, or TJX or Urban Outfitters. And it's that idea that people still want a connection and they want an analog connection, despite the pandemic and everything turning into digital e-cards or digital outreaches. This is
I'm still a big believer.
I'm
still a big believer in the physical cards and everything else. I know, I mean, some kids, I guess they don't really care, but you know, I just think it's a better.
Gen X to the rescue once again.
Yeah, absolutely here. And you know, we kind of talk about this in the context of the earnings, and you know, we've already gotten Walmart, we got Home Depot, which is a different type of retailer. We're supposed to get Urban Outfitters, I believe, tomorrow after the bell. We get TJX before the bell. So we'll get a little bit more of an insight into what's been going on with retailers and whether the consumer is still willing to spend.
Right, and I think that's an important point because when a company like Walmart comes out and says that it's going to be a bit cautious in the outlook, that rings all kinds of alarm bells. It raises all sorts of questions about which kinds of companies still have their customers' loyalty. Are customers loyal in this day and age when prices are high and they need to be kind of on the lookout for the best deals possible?
I do wonder about that too, because I mean, we talk about Walmart, which is obviously supposed to be everything to everyone, right? You know, you go there when times are good, you go there when times are bad, because you know you're going to save money, relative to some of the other retailers. But what about those other retailers? How do they hold up? What happens when we hear from the department stores? What happens when we hear from some of like the individual apparel companies, kind of the standalone ones? Are they going to be doing as well that are much more discretionary?
That all comes down to inventory management, whether they've made the right decisions in months past and their ability to figure out how much they should order so that they don't have to discount and then move that inventory months later at a loss.
Yeah. So here's my question for you then, Scarlett. So so I think we have Robin and Carmelle are still there.
That'd be great.
Sorry, guys, we're getting through this. So I mean, how did you actually get into these stores here? We were kind of talking about this idea. I mean, how do you get an Urban Outfitters or an TJX to even take note of you?
Yes, I can kick us off. Thanks again. I think we owe a lot of credit to our social media account. As you said earlier, I'm a writer, Carmelle's an illustrator, and we had to do a lot of self-promotion in the beginning. We've been running for nearly 10 years now, and just kind of boots on the ground or literally boots on the subway, making sure people knew about us from word of mouth, and again, our social media presence. And with our creative copy and with Carmelle's illustrations, we just quickly got the attention of buyers. We also were fortunate to participate in a lot of trade shows. And so again, just building those relationships, trying to find contacts in the industry, that's what really got our foot in the door.
When you design products, Robin and Carmelle, are you looking to localize what you're creating for stores in certain geographies? Or are you thinking, even though this might be very specific and niche, we think there's a market for it regardless?
We do. We look at local trends. We have some cards that are just local to Atlanta, talking about traffic in Atlanta, things like that. And then we also look at trends that, span globally or nationally, so that we can kind of appeal to every consumer.
Are you planning to expand this business beyond greeting cards?
Yes, absolutely. When we started off, we just had a few greeting cards. Then we quickly moved on to notepads, calendars, just really anything tangible that speaks to realness, that's witty, that still has our company core values at its heart. That's a product we want to make.
All right, Robin. Carmelle, it was great to meet you. We got to get you back on for a little bit of a longer conversation. Apologies for those technical issues. Robin, Beck, and Carmelle Kendall, the founders of Neighborly Paper, as we wrap up here on The Close. And of course, a big day tomorrow with a lot of big earnings, including probably one of the biggest of all.
NVIDIA is going to be reporting at 4:20 p.m. We will be all over those results, so you want to tune in right here as we break it down for you.
A lot going on in Washington as well. Stick around. Joe and Kaylee are up next with Balance of Power. That's coming up right here on Bloomberg.